Welcome to the May 18th, 2020 Advance Report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman and President, McGowan Group Asset Management. Through the crisis, we are here with you each and every week, and as needed. What we'll be doing today is our fast-paced tour of the global financial markets and investment strategy discussion that you just can't get anywhere else. McGowan Group Asset Management, a team of 9 dedicated professionals with vendors, data sources, and what I believe to be one of the best research platforms in the industry. We will prove it to you here in the YouTube video each and every week. So be sure to subscribe. And if somebody's asking you, what are you doing in the markets? Well, it's a good thing to do is just forward to them the YouTube McGowan Group link. We start with, as usual, the Dow year to date, because that tells the story of the implosion, a 38% decline in the Dow, 29.5 to 18.2 we'll call it. And what's happened since? A rebound rally to about 24,500. This week, a couple of events took the luster off of that rally, and there's a normal settling process going on, as you can see from this range right here. If we said, what's the range of the Dow for the next 12 months? If you ask a trader, he might tell you 21,000 to 27,000, give you a wide range. And right now, we seem to be sine waving just below that 24,000 mark as usual. That's about the midpoint of this correction here. Back in 2008, 2009, delevering as the real estate industry, the mortgage industry, all over leveraged, and the banks too. Well, the banks have plenty of liquidity. Their reserves were 7 times as large in percentage terms as they were back in 2008-9. So that's not the problem. The Fed's provided plenty of liquidity, $2 trillion, $3 trillion in the CARES Act and the other relief acts. That liquidity making its way into the system. Does it overcome the damage from the April shutdown? Is the restarting of the economy fast enough to actually save from bankruptcies is kind of the question that's happening right now. OpenTable predicted this week in a news report, their executives saying you could have 25% of the restaurants that don't come back from this. So that kind of dire news puts a lid on the Dow for the time being. Now, midweek, we had 2 things. Dr. Fauci gave a speech, but didn't talk about any of the medical research going on to solve the crisis. It was rather dire. He was testifying in front of the Senate. In exchange for him working 12 to 15-hour days tirelessly, he gets a subpoena from both houses of Congress, goes to the Senate, but gives a very dire forecast saying we can't even reopen school and it'll take 2 years for a vaccine. Well, what else are they doing up there besides attempting to solve the problem? There was no forward vision. Not much forward vision from Fed Chair Jerome Powell, and consequently the Dow midweek about 22,800 at the low, about a 1,500 point downdraft, in part because Powell and Fauci expected to provide forward vision, did not. They seem to be simply hedging in Washington speak. All right, what's the real forecast going forward? This one, I am just doing year by year economic growth. 2019 was 2.3%, by the way, to put it in context. That was the economic growth last year. Of course, that ended in January, February. Well, what's the real updated forecast? Right now, the Bloomberg survey of economists, about a minus 4.6%. We'll say a minus 5% for the economy this year. Well, that's actually a lot better than the minus 27% projected for this quarter. Then you get a rebound, and the sum total of that is about a minus 5. Next year, 3.8%, we'll say just below 4%. So you get back to about 97, 98% of where the economy was by the end of 2021, and 2022 is the first chance for the economy to see a record level. Is that important? It is, because that is actually not as dire as the 2008-2009 economic crisis. That's why these forecasts are so important. And if that's the case, this time next year we figured out how to operate safely. By the way, McGowanGroup clients and prospective clients, the in-office planning sessions will resume June 1st with safety precautions and making sure that a healthy team is here to serve you. Come see our new offices. We're booking appointments for June and July for those that would like to update their plan, both clients and prospective clients. Now, this is the high yield index. I'm going to go into 3 investment categories. Whether they're appropriate for you or not, we'll decide in your planning process. But corporate B-rated high yield bonds, that looks a lot like what you see when you drive by a bank. Inside that bank, there's loans and bonds, right? They earn interest every month. They have a default rate that they prepare for, and that's normally around 2%. It may go to 5% from here. What is this? This is the price of a basket of short-term B-rated corporate high yield. Not C-rated, not distressed. You've got A, B, and C. A, AAA is treasuries. The B market is generally the corporate mid-range market. So par is 100. Bond matures at 100% of what the loan comes due at. Well, it went all the way to 61.50 back there in 2008, 2009. So you get almost 60 cents on the dollar. Wow, it's a 40% discount, but the default rate only went to 10. Consequently, you see a big rebound. High yield bonds recovered a lot faster than equity. It took equity all the way till about right here to recover, whereas the high yield index recovered most everything by the end of 2009 plus interest. We got all the way down to below 70 cents on the dollar. Wow, that implies like a 30% default rate. In the Depression, it was about 20%. And now we're priced at about 78. Jerome Powell's infusing liquidity into the corporate bond market, by the way. All right, what's the strategy? This is the 5 years. We've covered this before, but I want to re-emphasize it. If you took a basket of domestic corporate bonds and loans and global high yield, and you just simply reinvested, you can see the price shock right here, similar to that high yield index, not without price volatility. But the recovery fast. And what happened over the 5-year period for an investment plan? Global high yield was about a 14% average return if you reinvested, and here about 10% on domestic high yield. Not without price risk, but that could be the part of the market that recovers much faster because of the actions being taken globally to contain COVID and also to move out to, let's say, liquidity for the corporations that need it in the meantime. So the default rate may be 5, maybe 10%. We'll see. All right, Kinder Morgan, Enterprise Products, Energy Transfer, 3 leaders in the pipeline industry. We don't do speculation in oil and gas exploration and production. We like to own the pipelines for income. Where are they priced now? Well, you can see the 2008 low. Energy Transfer, for example, went from 3 all the way to 35. What's the real value of these companies? I would say it's somewhere in here, and yet we're priced right here. What does that mean for investors? I can get a dividend. It may get reduced while pipeline flows are down, but the future of the oil and gas business is still there. And the question is, where are we next year? Somewhat reduced demand, but the prices reflect something that may be like an absolute market disaster. You already went to here for Energy Transfer, and that's where Blackstone came in and bought 7% of the company, and they usually know what they're doing. Just a forward look here, where are the futures in oil? $38 at the beginning of 2023 is the price of a contract out there. And you recovered from the minus 37 a barrel. Oil settles next week, so we'll see if there's a big downdraft from the speculators who can't take delivery next week. This is natural gas. It really never budged. $1.70 out to $2.70 for January 2023. So those are already building in a recovery. Any short supply from reduced production could lead to a return above $50 a barrel for oil, and natural gas potentially above $3, especially if there's a cold spike next winter. One last point. We added medical dividend companies, And you can see the medical dividend companies actually had a huge downdraft, and we added some of the medical dividend companies. This is the S&P healthcare sector, but we were focused on getting the higher dividends and the companies that could be permanent beneficiaries from the effort to protect against future outbreaks. And certainly that category recovered quickly. That's an interesting dividend category as well for our model portfolios. Come see us at the Crescent. June and July, we're booking the appointments. You can always go to networthradio.com. And the team has become very good at virtual online meetings. And if you just want a traditional phone appointment, that's fine too. We'll use phone and email, or the Zoom meeting mastery has been a mandate for the team to serve you well through the crisis of 2020. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowanGroup, your financial weatherman. We sponsor each week NetWorthRadio.com broadcast. That has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as networthradio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to networthradio.com, the McGowanGroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors, and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast. And that can actually work to your advantage. We'll build that into your plan. So I urge you to go to networthradio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast, or any securities, doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.